Direction of this topic in the movement in cycle of the organization financial report system, management accounting information is produced to lay, to aggregate, and to distort to be relevant for managers' planning and control decision. With increased emphasis on meeting quarterly or annual earning target, internal accounting system focus to narrowly on producing a monthly earning report. And despite the considerable resources devoted to computing a monthly or quarterly income figure, this figure fails to measure the actual increase or decrease in economic value that occur during the period. Consequently, in this article said that management accounting report are a little help to operate managers attempting to reduce costs and improve productivity. Frequently, the report decrease productivity because they require operating managers to spend time trying to understand and explain reported variance. Reported variance is the document that compare between planned financial outcome with the actual financial outcome. Furthermore, management accounting system do not provide timely and detailed information on process efficiency, or they focus too narrowly on input such as direct labor that are relatively insignificant in today's production environment. Next, the management accounting system also fail to provide an accurate product cost. Costs get distributed by product by simplistic measure, usually direct labor based, that do not represent the demand made by each product on the firm resources. The standard product cost system, which are typical of most organizations, usually lead to enormous cross subsidiaries across product. Lastly, this article also said that managers' horizon contract to the short-term cycle of their monthly profit and loss statement, so that managers under pressure to meet short-term profit goals by reducing their expenditure on such discretionary investment. Thus, short-term profit pressure can lead to decrease in environment in the long run. Today, as we can see, management accounting system provide a misleading target for managerial attention. They fail to provide the relevant set of measures that reflect the technology, product processes, and competitive environment in which the organization operates. Financial managers relying exclusively on periodic financial statement for their view of the firm get insulated from the real value creating operation of the organization and fail to recognize when the accounting numbers are no longer providing relevant or appropriate measure of the organization operation.
The challenge in rise-fall of management accounting, rapid progress in product and process technology, and wide fluctuation in currency exchange and raw material price demand excellence from corporate management accounting systems. An organization management accounting system must provide timely and accurate information to facilitate efforts to control costs, to measure and improve productivity, and to devise improved production process. The management accounting system also need to report accurate product costs so that pricing decision, introduction of new products, abandonment of obsolete product, and responses to the appearance of variant product can be made with the best possible information on product resources demands. Finally, a large decentralized organization requires system to motivate and evaluate the performance of their managers. This system should provide appropriate incentive and signals to the managers working in different functions with diverse product and processes amid a globally dispersed operation. The organization management accounting system serve as two vital ways of communication linked between senior and subordinate managers. It is the means by which senior executives communicate to subordinate and decentralized managers the goals and objectives of the organization. An excellent management accounting system will not by itself guarantee success in today's economy. Ultimately, success depends on the products that meet customers' needs, on efficient production and distribution system for this product, and on effective market efforts. However, an ineffective management accounting system can undermine even the best effort in the product development, process improvement, and the marketing policy. With an effective management accounting system, the best outcome occurs when the managers understand the irrelevance for the system and bypass it by developing personalized information system.
Increased demand for management accounting system occur at a time when the cost of collecting, processing, analyzing and reporting information have been decreasing. With many production processes under direct control of direct computers, information can be recorded in real time for analysis and of operating performance. In highly automated parts recognition and tracking system combined with local area network, technology can provide continuous status reports on work in progress. Extensive systems now can accurately measure and attribute the resource demand made by each product and a diverse product line. Timely and relevant managerial performance measures can be computed and disseminated throughout the organization. Today's designer of management accounting system can use sophisticated electronic technology to devise reporting and control systems that are more accurate, more timely, and hence more effective than those designed by their predecessor. Simplified and aggregated procedures that were adopted in early decades because more relevant and timely procedures would have been too costly and no longer need to be tolerated. The past 2 decades has reducing information collection and processing costs that it have been removed virtually all barriers to design and implementation of effective management accounting system.
For the management accounting roots, there were 5 themes that I will discuss, which is before 19th century, on 19th century, at the middle of 19th century, last 2 decades of 19th century, and early decade of 20th century. For the first is before 19th century. Before 19th century, the exchange transaction only happened between the owner and individual who are part of organization. There is no level of management, which means no hierarchy, no CEO, no director, and no long-term employees. And then the owner need to collect more cash sales with the customer rather than paid out to supplier. Next is on 19th century. In the 19th century, that also called as Industrial Revolution. In this century, the owners start to commit lot of money in the production process, and they start hire long-term employee to avoid bearing all the costs and risks in the labor market. Not only has that, leaking in the price information occur in the conversion process because of this convergence. The owner devised to measure the efficiency by which the labor and material is converting into finished good, and they evaluate the manager who supervises this conversion process. This measure seems very simple, but the needs of manager and owners seem to serve very well. At the middle of 19th century, a good advance in communication and transportation happened, especially during invention of railroad and telegraph. This happened because they gained more access on acquisition of raw material and distribution of final product. Therefore, effective and efficiency of management accounting is necessary to keep up the quality and the quantity. Besides, Many retailers develop their own measure on internal performance to support their control activity and managerial plan. For the second last on this article is on last 2 decades of 19th century or scientific management movement. The goal on that time is to improve the efficiency and utilization of labor and physical standard. The finished good unit costs were calculated to aid managerial decide not to produce external statement. And for the last is on yearly decade of 19th century. On this yearly decade, the development happened on it to support growth of multi-activity and diversified cooperation. So return on investment or ROI is the most important for management accounting innovation because it provides overall measure of commercial success of each operating unit for entire organization.
Next, we're going to focus on lost relevance. Lost relevance is the pace of innovation seemed to stop in the mid-1920s. Perhaps there was incentive to continue to develop innovative management accounting procedures because the corporate organizational forms developed by a company such as DuPont proved to be the model for many corporations for the next half-century. When the time comes, the needs for accurate product costs and effective process control should have imposed new demands on organization management accounting system. Unfortunately, led to today's problems such as distorted product costs. Also, the cost of collecting data and providing prompt reports to production managers may have been too high to permit the real-time process control that is now possible. Hence, the decision by managers to not invest in management accounting systems separate from those already mandated by the demands for audited, predict financial statement may have been the correct economic decision. The benefits from more accurate and more responsive management accounting system may not have been worth the cost of maintaining such a separate system. Left unquestioned was whether the system were still mindful given the great expansion in information technology represented by electronic digital computing.
We believe academic will lead astray by focusing on a simplified model of firm behavior and illustrating the simple one-product settings. The academic researchers attempt to implement their ideas in actual organizations with complex multi-stage production process. Management accounting systems have become less relevant and less representative of the organization's operation and strategy. Many senior executives who believe that they can run the firm by the numbers, lacking of information and uncomfortable with their underlying technologies, the CEOs increasingly look at the project short-term impact of the decision making on the financial measurement, especially earning per share and return on investment. But as product life cycles are shortened and more costs that are incurred before the production begins, directly traceable product costs are much lower than the fraction of total costs. Consequently, traditional financial measures such as periodic earning and accounting ROI are less useful measures of corporate performance.
Accounting for caravans. If we return to 15th century and the publication of accounting book by Fra Pacioli, we can ask what kinds of events were occurring that led to a demand for accounting information. Undeniably, Merchants in Venice were trading goods with other countries. For example, consider a group of Venetian investors who acquired goods product in Italy and chartered an expedition to sell these goods in India. Once were sold in India, the traders purchased tea, traveled back to Venice and sold the tea. At the end of progress, the accountant subtracted the cost of the caravan and the cost of acquiring the initial load of merchandise from the revenues received from the sale of tea in Italy to compute a profit. Role for accounting is to compute the overall profitability of the venture and to apportion the net proceeds among the investor. Debating that it is meaningless to allocate project profitability to short time periods within the life of a project does not imply that we believe it fruitless to attempt to own valuable indicators of short-term progress. Returning to our Venetian expedition, there probably are many measures of the caravan performance during the third quarter of 1487 that the investor would be interested in knowing. For example, what distance did the caravan cover and in what direction? Or what is the condition of the inventory being transported? Many potential indicators, but quarterly profit is not one of them. In the current competitive technological environment, probably there are many better indicators of a company's short-term performance than its quarterly earning. Cash flow is important, and we want to know that the pattern and structure of a company's cash receipt and cash expenses, and also concerned about amortization, capitalization, and other accrual.
Lastly, the needed innovation in rise-fall of management accounting. Management accounting system can and should be designed to support the operation and strategy of organization. The technology exists to implement systems radically different from those being used today. What is lacking is knowledge, but this knowledge can emerge from experimentation and communications. The innovative spirits of 100 years ago at the outset of scientific management movement can be recaptured by creative managers and academic researchers who are committed to developing the new concepts for designing relevant management accounting systems.